Hi guys, thank you so much for joining me in another video. Today I'm going to be talking about FOMO. That's the fear of missing out. That's what all the young kids on the block are talking about these days, and all of these little acronyms that they have. So just get down with it and get down and let's get to know what FOMO is and why do we have it as investors in the market. As you all know, when it comes to investing in the markets, I'm actually quite a passive investor, and generally finding through my readings that having a beta to the market is better than trying to seek the alpha. So I love these geeked out financial terms, by the way. Beta actually means taking market returns. Conversely, alpha means trying to beat those market returns. So the alpha beta situation, now this is not ideal all of the time, and the topic itself is quite divisive. Active investing itself still remains the dominant form of investing, but passive now accounts for about a third of that, according to reports. So there have been numerous books I've mentioned in my chats before, though a new one I have read is called The Incredible Shrinking Alpha. That's quite a catchy title actually, and it's by Larry Swedroe and Andrew Birkin. And on the whole, it advocates for passive investing, but also takes an objective look at how active investing can be useful and getting the best out of both worlds. I'll pop a link down below in case it tickles your fancy. So the main topic of today's video, like I said, is FOMO, the fear of missing out. So as someone who is passive and watching from the sidelines usually, it's pretty much impossible to not feel that FOMO feeling and at the same time make no sense of what is actually going on around us when it comes to the market. The relative outperformance of certain stocks, commodities that defy reasonable expectation makes me personally question what I'm doing as an investor. And then I quietly reassure myself that I'm still part of the craziness, just one step removed from it. That's the rationale, I suppose. Having said that, when all things are perfect, investors are rational people, right? We're all just normal. We make independent and rational decisions based on the world and information around us, just how anyone would do. And I have to agree there are some biases, but there are two sides to every coin, and they cancel out to create that rational, reasonable market that reflects consensus and information fairly well. And yes, there are those small caps that have stellar performance and grow at a pace outstripping market expectations, and then you do have those beaten down companies, and those are pretty much classed in that contrarian investing strategy, which can also deliver market beating returns but also have a significant risk attached to them. But that doesn't mean that the market is inefficient, right? It generally points to direction that there is fair value of taking risk on smaller, more riskier stocks, or investing against the herd by doing research and spotting an opportunity that others may not have. And that makes sense. So let's talk about these tech convictions. Based on the market trends, sometimes sticking to your convictions becomes too high, right? So let me explain that. So whether you believe that tech stocks, which are in vogue and in fashion at the moment, are good or bad stocks, whether or not the high prices are justified or not, the potential cost of not holding them is actually huge. So I reflect on my own FOMO there as well. So with Tesla being a great company, but the valuation not really making sense, some investors may not have dipped their toe in the Tesla sea. We all know how well long-term investors have been doing this. So, and then on the other hand, there's my lesser favorite, nonsensical Nikola, which has now, with the deal with GM, more than tripled in price, and it remains a roller coaster ride for them. But that aside, let's continue to take the sector view. What about tracking those convictions? One of the ways to do this is by looking at what investors call tracking error. So from a scientific perspective, everything is measurable. This is a super important concept, which basically means how closely your investments will track the benchmark index. So it could be tracking the FTSE 100 or the S&P 500. So for instance, if we buy a passive index fund that tracks the S&P 500, the tracking error will tell us what the variance between our investment and the benchmark will be. So in today's world of passive funds, the tracking error is pretty tiny, and depending on the market, it can be as low as a couple of bips. But what do I mean by bips for us newbies? Bips is basically 1/100th of 1 percentage point. So something like 0.01 to 0.02%, and that is on the low end. it can go up to 0.1% at the very high end. Gosh, 0.1% at the very high end. Like, does that even... But yeah, from a scientific point of view, all of these tiny little changes make a difference. It does actually make sense to have a tracking error too, as it represents the costs the passive fund will pay in operating the fund. And so there should pretty much be a small negative tracking error when it comes to that. So let's talk about the top 5 companies in the S&P. So you can take tracking error further, though less important with active funds as they don't track the market. The tracking error in this instance is referred to as the active return or alpha over the benchmark, and you would like this to be positive over the long term. Okay, so if not, you'd be better off buying the index and just being safe. Through my reading, I did see this concept being taken one step further, and they do this by taking the tracking error of the top 5 companies in the S&P versus the other 495 companies. So the top 5 companies are Alphabet, which is Google, Amazon, Apple, Facebook, and Microsoft. So the tracking error number itself was 5% over the last 3 months. But what does all of this mean? If you're still with me, hang on in there. So since the 1990s, the tracking error has been in the region of 1 to 2%. And the only time in the last 30 years where it has been higher than now has been during the dot-com boom. And that is what that means. This tracking error is abnormal. Gosh, all of this does sound very technical, but it does have a very simple conclusion. So these stocks, they behave very, very differently to the rest of the markets, these top 5 stocks. And if you don't hold them, you'll have dreadful returns. That's just a fact. But does it matter? Well, it depends, right? So as a retail investor, you're not accountable to anyone but yourself. So there goes me in the corner crying because I didn't buy Nicola. However, if you're a professional fund manager, then FOMO is real, people. So professional money management is an unforgiving game, right? And that's why these managers are expected to beat the market and deliver alpha. So as the rise continues, more and more money joins the boom. Now, can these fund managers foresee when the correction occurs? Now let's think about that for a second. If funds can foresee when the correction occurs, like the last couple of weeks, for instance, then Bob's your uncle, right? The reality actually is active funds have as much chance of calling it over as a flip of a coin, really. In fact, only half of active fund managers will beat their passive peers, which is exactly like tossing a coin when you look at the probabilities. There is a lot of speculation as to whether that tech boom is now over and will we see the tracking error bounce back to normality, or whether it will actually just continue as it is. But when the FOMO is real, it does actually help to put things into a little bit of perspective. So there you have it, tracking errors or not. Are you holding on to any of the big 5? Let me know down there in the comments below. Don't forget to like, comment, subscribe and all of that jazz. But until next time, cheers guys, bye.